happy to be here. My name is Ashim Megonjobi. I'm the managing partner of Terra Capital. We are an early stage venture capital fund based in Lagos. We invest sector agnostically, impact focused across Africa. Next lady, she has one.
I have the mic. So my name is Christine Miner. I lead the team at the East Africa Venture Capital Association based in Nairobi. We have a membership of 104 members across East Africa with assets under management of over $3 billion.
Too much chivalry. Hi, everyone. My name is Toyin Emmanuel Olubake. I'm the Chief Investment Officer at Catalyst Fund. Catalyst is a climate-focused venture capital and venture builder deploying across Africa in climate-adaptive and climate-resilient businesses. Thank you.
Hi, everyone. My name is Cyril Shonibare. I'm part of the investment team at TLCom Capital. We are an early-stage focused Africa technology investor. Typically invest in seed and Series A stage businesses. And we write between 1 to 3 million in first checks that we deploy into companies. We're currently investing out of our second fund, which we closed last year at 154 million. Looking forward to the panel.
He has money to give you. You're a founder, a growth stage founder. All right, thank you, everyone. Can we start from Christian? Oh, you've not?
No.
Apologies.
That's fine. Thank you. Babacar Sek. I'm the managing partner of AfricArena Investment Partners. So we're a venture capital fund investing out of Dakar, Lagos, and Paris. And we focus specifically on startups that are boosting productivity across key sectors of the economy in Africa. Thank you.
Thank you so much. Christine, if you would like to take this up, we have a first question, right? And it says, what sectors or industries do you think are being currently overlooked for investment opportunities? If you can speak specifically to certain industries, sectors, geography, whatever you want to share, we're all ears.
Thank you. And I think this is going to be an answer that goes across because we all do know the sectors that are overlooked. But specifically for East Africa, however, we're seeing a change in this. Sectors like blue economy and the creative industry have for so long been overlooked. And I think it's because they do not fit the VC playbook. Yeah. So we all focused on fintech and every other, Agritech and everything else tech. But then we're not looking at what is really ingrained in the African culture. And I think just overlooking some of these sectors, for example, blue economy employs over 49 million people in Africa. So that's a very huge sector to look at. And I think if this continues, then that means that investors who are looking for real returns should be looking at solving real problems in Africa. If you miss out on these kind of sectors in Africa, then that means in the future you're really going to miss out on real returns. But for us, those are the sectors that we're seeing being overlooked. But I think currently we have one of our members who's very much supporting the creative economy, Hiva Fund, and doing a lot of work with Mastercard to support the creatives in that industry. But it just goes down to the models for VC, and where the money goes is where we also.
Thank you so much. Mabaka, do you want to jump on that?
Yes, of course. I think rather than sectors, it's certain business models that we see are less invested that are very strong. And they're the business models around productivity. And productivity means just to increase the revenue, decrease the cost of operation of your customer. And we see a lot of startups today that get funded that focus on consumer. But when you look at what is really generating the more value and is more resilient in times of crisis, it's businesses that drive productivity. Because like one of the startups we saw earlier, when you're helping a SME to increase their revenue, when there's a downturn, when there's a macroeconomic crisis, they're not going to shed you because you're helping them to be more successful. And that creates a positive flywheel. Now, we see productivity-driven businesses across multiple sectors. You will see them in education, because when you help someone to get a job, they're not actually spending money. They're investing money into future income. When you're helping someone to have a better healthcare, you're helping them to safeguard their health and their future source of income. Same thing around insurance, which is a sector that's very overlooked, but helps people to be more resilient through crisis. So those are the kinds of sectors that we believe could be more interested.
All right, thank you. I would like Asim to speak to this, and then we could jump to something else. Yes.
Thank you. So I think this whole topic is super interesting because it's not only what we should be investing in, but we're not, but it's also like what markets we should be investing in, but we're not, right? What business models. So it's actually a whole, broad topic. So thanks for, letting us speak about it. One of the things that we look at is really like how does data play into, what we require in the African context, and that sort of cuts across sectors, but it's still pretty underinvested actually. So if you think about the healthcare sector, for instance, Africa doesn't have a lot of data out there, whether that is in studies, right? So the studies are not funded, whether that is with regards to what data manufacturers have available to actually then produce for the continent, or whether that is even with regards to local country-specific contexts where you think about, okay, well, what pharmacies have what drugs available, for instance. But data also cuts across things like climate, for instance, and climate adaptation or mitigation. So, for instance, we're invested in a startup in Tunisia called What Now, and what they're doing is quite smart, actually, and they're helping companies track their data, especially with regards to their, output, and then to say, well, how can you actually, do better with regards to your, climate productivity and ensuring that you actually don't spend as much money on, your air conditioning, for instance, and all of that. So data is really a big gold mine that we're not really investing in at the moment.
So it's interesting that you're mentioning climate, so I'm going to go to Tony, right? Because we play in the impacts and sustainable development space, right? So my question is, how can we balance short-term financial gains with long-term sustainable investment, right? Because capital needs to appreciate. And we also want development in the economy for Africa. So how do we win-win and not lose-lose or lose-win?
It's a good question I don't have an answer for. No, really, I can't say I have an answer, but thoughts certainly. So the first thing is, in the context of investing, especially private capital, venture capital, short term is very contextualized because a venture capital fund is typically a 10-year fund. And even in the developed markets, the average time it takes for a whole fund to be invested and returned is now between 12 and 14 years, call it 13 years. And so that contextualizes short term, because the irony is that most builders, entrepreneurs, even in those markets, will tell you that it's barely enough time. And then when you now bring it to our ecosystem, where a lot of times the transformative entrepreneurs are not just delivering solutions, they're building the entire value chain and infrastructure that allows them to deliver the solutions, which means that it requires more money and more time than it would take their counterparts to deliver the exact same product in another market, which also means that typically they will have lower margins, might have lower margins than their counterparts, and then they're selling to markets that are not as economically robust. So that's the downside. Very exciting, isn't it? But I mean, the upside is that I think, and this comes to the question, I think that venture being an innovative, an ecosystem around innovation, there's room to think a lot more innovatively about, one, the sources of capital that we tap into. And again, we're seeing that even in the developed markets like the US, where some of the larger, more established venture funds are now becoming listed. Some of them are listing their fund manager entities. Some of them are not listing the fund manager, but they're trying to list funds. Because then that allows them to tap into different sources of liquidity, have different tenors. So that creativity, I think, is going to be the bridging solution. I think for Africa in particular, the diaspora are a very interesting potential because there is generally more capital than you'll find on the continent at sort of like a retail to lower HNI level. But there's still an interest. There's a desire to be connected to the continent. A lot of people are seeing the businesses that are being built becoming successful, that even brand investors from the US, from Europe are investing in. And so that's creating an appetite to participate. And so how can fund managers think about different approaches to raising capital and maybe even different instruments to invest with that could then bridge that gap? And so it's a lot of grammar, but then what does it come down to? I was speaking with an investor yesterday that, for instance, said that in the climate space, they raised a small fund, about 3 million. So not your typical approach to fund management from day one. But their plan is to fully invest and return that within, I think, 5 to 7 years. And to be raising those sort of funds every other couple of years, every 2 or 3 years. So that's already a different approach that's allowing them to be a lot more nimble, go to the ground, meet with the companies that are early stage, need this capital, help them to build. You're not trying to chase unicorn exits because you're coming in early. So if you're coming in when a company is valued in single digits, let's say 2 to 5 million, and you're exiting when that company is valued even at above 50 million, you have pretty decent returns. If you are over 100 million, you have pretty great returns. Looking for billion-dollar businesses in Africa is a bit difficult. Looking for $100 million businesses in Africa, it's not easy, but it's not as difficult by any stretch. So that's already
So in
happening.
conclusion,
That's already happening.
yes.
And that's
So we seek
examples
for
of how
alternative forms of capital that may be a bit more patient.
alternative sources of capital,
Okay.
alternative structures of funds, alternative instruments that are suited to the environment.
Thank you very much. And I would like to come to Sarah. I would like you to speak to emerging technologies or trends that you believe are underinvested but hold significant potential anywhere in Africa that you've kind of like looked at.
I would say that AI is one, and not in the sense of which we see typical startups or businesses approaching it, or the angle that they do, right? I think that there's a bias towards moving investment activity and also innovation towards the models that we see coming out of the West. However, there are local solutions that are being ignored when we just focus on replicating what we see externally. And I'd say that leveraging local data sets, even though they're not that many, as Ashim was mentioning, but we do have some data being captured on the continent, and leveraging the existing technologies with AI and machine learning to help solve Africa's specific problems is something that I personally have not seen enough of from a startup activity perspective, and that's something that would be encouraging to see more of, because the technology, the foundational models and the foundational technology has been developed by our Western counterparts, but we can use our local insights to solve local problems and not just copy and paste what we've seen.
All right, thank you so much for sharing that. I would like to go to common misconceptions or biases that might lead to online investment in certain areas. So we've spoken about business model. We've spoken about the issues in East Africa, not issues, the underserved markets with the blue economy and creatives. We've spoken to, business model more or less, and business model, right? But are there common biases or misconceptions that is making a sector like zero? Like, you're receiving no funding because this is how investors think about you guys. I know that it's not that bad, but are there common things that kind of happen now? Like, this is the reason why we didn't say it. We say it among ourselves. We can never say it. But this is the reason why nobody's calling you back. Anyone? Yes.
You're absolutely right. I think there's actually quite a number of sectors that have really strong stereotypical biases attached to them. Education, health, no matter how technological the solution is, are always seen as impact or social impact sectors, i.e., you're going to have a lower exit, right? And in the end of the day, and this is the beauty, but also sometimes the challenge in venture capital, is that everybody is looking for a fund returner. Everybody is looking for that one unicorn, or that one business that is in fact going to, go to the moon. So, we've really got to think about, okay, well, if we already have these biases in our minds, then, we're actually not giving these sectors a chance. And the same with countries, right? Some people will write off certain countries just because they have these biases in their mind, right? Nadia is sitting here from Jamba Capital, and I know that Francophone Africa is absolutely underinvested, right? Especially considering the solutions out of there, the talent, especially if you look at the overall market size. So,
language is a barrier also.
Language can be a barrier, absolutely, right? Because we don't know enough. But there's lots of biases attached, and I think mostly the bias is always around this is a sector that is more impact, so therefore it is not commercially attractive enough.
Okay, so let's go back to Toyin. I would like you to speak to your space. Where would you say that there's room for more impact investing that is also commercially viable?
Climate. Obviously, that's why we're focused on it. Look.
Because every tech I see, we have 5 SDGs we're aligned with, because they want free money and all that stuff. So where should we be looking if we want to give impact people money?
Look, I'll answer the question 2 ways quickly. First is, I do think climate is a big opportunity, and I'll explain the view on climate.
Okay.
When people who hear the word climate, oftentimes what people think of is climate science. And then from an investment opportunity, you're then going to think of mitigation. And so are you then planting trees? Like, what are you doing to actually move the needle on mitigation? And there are a lot of solutions in that space, and we're even investing in one. But for the continent, I think that the real opportunities are in adaptation and resilience. Because whether or not you understand or agree with the science, the reality is that rainfall patterns are changing. That is putting food systems at risk. Productivity is low, it's erratic, and so solutions addressing that are critical. You don't need to agree with anyone else on the science side to see that there are opportunities there. That's an example. Or in energy, whether that is in power for homes, power for businesses, power for vehicles. Again, huge opportunities that's happening in sets like that. And so when you think of climate, there's that side of things that we think are huge opportunities. But because the branding of climate immediately puts people to think about mitigation, where there's a lot of even political tussling around that at the moment, a lot of people then discount how much opportunity there is under that theme.
Thank you so much for sharing. Please, can we give my parents a round of applause, please? Are you guys not learning? All right. So we have a few more questions to go through, and I'm hoping that the audience has 1 or 2 for us to add. So I will go back to Babaka, if you can give us a minute. How can investors mitigate risks associated with investing in new or non-conventional areas? So VC money is already high-risk money, right? And they are going to place, we always say there's no data. So you're flying real blind. There's been no exit, no pathway. The innovation is very raw. So how do we mitigate risk?
I think first, risk is the job of venture capitalists.
Thank you.
So, now we have unicorns, we have exits in some sectors such as fintech, but the people who were investing in Paystack or Andela in 2014, 2016, there was nothing. When Jumia was founded in 2012, there was no e-commerce market outside of South Africa and Egypt. And so I think the role of managing risk is really focused on assessing the potential and assessing the demand. Because if you do not have a good understanding of what people need, and if you're not providing a solution that is addressing that need, then there's no business. Yeah. And I think sometimes we lose that when we get some fancy ideas and try to think about problems that are really far in the future when there are so many issues to be solved today in multiple sectors. So I think the first thing is to make sure that there's demand for the solution that is being built. And then at least our approach when we go into sectors that we understand less, well, we don't start from the perspective that we're investors, we have the money so we know everything. That's not true. So we will partner with people. We could partner with other fund managers that have an expertise, say in climate or agri or blue economy. We're going to partner with operators. Actually, that's how our model is built. We have a team of operating partners who are people from the sectors that we invest in. And they help us to understand those sectors much better and make sure that we're actually doing something that makes sense. So I think going to the people who actually know and who actually do is the way to go.
So a lot of market research, basically, to be sure. And then also investing in, hopefully, the next billion.
I mean, I really agree with what Babaka said, and there are two things that I'm going to emphasize. The first is that everybody who manages money professionally is a risk manager, whether you're a bank, asset manager, stockbroker, VC, PE, whatever. And so the next point is that proximity to context is key, because that is what enables you to dimension risk and then to manage it, not avoid it. The opportunity is in identifying the risks that are actually worth taking. Quick example, in 2019, 2020, when MoneyPoint was then team-upped and pivoting from just building technology to moving into agent banking, it actually struggled a lot to raise money because a lot of people thought that the banks were first in line to win that market. And if the banks weren't going to win it, it would be because the telcos were going to get a license in any day and then kill the market. But then there were people who, because of their proximity to context, understood that telcos were not going to get a license at that time. And the banks were full with their stomachs eating from treasury bills and other things. And so it was actually still a competition between fintechs. And then it's about who can build. And so now MoneyPoint is the winner that everybody is in or wants to get into, but coming from Novastar that was invested in MoneyPoint, we know how much it was difficult to get investors into MoneyPoint at that first time because a lot of investors had a certain view of risk. And so, sorry, I know you're quick on time, but proximity to context matters at every level on the chain. So it's who's working in the GP sourcing deals and evaluating deals, who's on the IC, and even at the LP level, how well do they really understand the markets? Because they shape the strategies that GPs are then able to deploy.
Very quickly to add, this is a really key point, proximity to context. And this is also why, to the earlier point that I think Babakar made with regards to funding sources also, this is why for new investment adventures, maybe you've got to think about more creative funding sources, right? So maybe it is not your traditional investors at the LP level. Maybe it's not your traditional VC funds. Maybe it is a fund who, takes risk more into new adventures. Maybe it is a fund that has dabbled in creative economy once, so maybe they'll do it again. Maybe it is a H&I that has a family office and who's just willing to actually fund all sorts of different things. Yeah, the tickets may be smaller, but to start, that's exactly what you need. So sometimes we've just got to be a little bit creative with regards to who we're speaking with and why we're speaking with them, and then we may be able to get to the end of the...
Before you jump in, I just wanted to say that I think what you said is very important because I see founders pitching to every investor. Like, you need to know who your investors are. When I mean who your ideal investors are, like what's exactly is their, what's their thing, what's the investment thesis, and who have they given money to before, right? Just pitching to everybody, because that would just increase your nose, more or less, yeah.
Yeah, thanks. Just to add to what everyone's already said, and I agree with the statements made on risk. I think that as money managers, we have to be comfortable with risk, and this is the job that we're in. But beyond, proximity to being able to react to risk and, getting understanding of what those risks are and being comfortable with it, I think that we also, as investors, always have to be comfortable with the fact that no matter how much assessments we've done to quantify what the risk is and measure it, that what typically happens in practice is that we are faced with challenges that we didn't even think about, and we have to be comfortable with the fact that the risks that really play out in reality is not what we've considered, is not what we've written, and puts mitigating situations against, but I think alignment with the partners that you have collectively and conviction around, you know, the partnership that you have with the entrepreneurs and also with your LPs generally help support mitigating risk when they do arise.
So basically, you have to be agile and responsive to the markets? Yeah. All right. Thank you. Do you want to jump on that, Kristen? This question about risk, or you want to talk about the government side of things? Okay, government side of things. Okay, so how do you think that, and I would like you to be as practical as possible and give us insight from East Africa, right? What do you think that the government can do differently to make capital come into the continent and then go into the places where it can help the economy grow?
First, I'd like to ask if we have any regulators in the room of government, because we are having these conversations amongst ourselves, and I feel like we all know what government needs to do. Yeah, we all know what government needs to do. A lot of my work is really lobbying as EAVCA, and I can tell you that's the work you don't want to do but has to be done. One of the things that I've realized is, and I do not blame our regulators or government, is that they do not understand. They do not understand our models. They do not understand how business is done in this sector. And so the first thing that we've had to do is create a lot of awareness and education. Another thing is the perception. So there's a perception which is pretty normal that VC and PE, like ourselves also, is that there's just a lot of dollars coming from wherever, and you know, we don't even know why you're crying for regulations. You already have a lot of money. So there's a perception of you need to pay this amount of taxes because you're already privileged. And I can tell you, so when we get down to the details of what, especially our startups, in Kenya, we're working with the university hubs and the vice chancellors to just make sure that there's this awareness, even as we're lobbying with government. So what we found to work is showing the data. Not just educating our regulators, but show them the impact that the industry, the sector has. So we show them things like, you know, pay as you earn, what's the VAT, and now the conversation, that's a conversation starter. Now following on to that, definitely we do need to ensure that there's a friendly business environment for our investors and for us to be able to pull in more capital. And I think for East Africa, they're really coming around. When you look at Tanzania, we have a PEVC regulation that's already been drafted. When you look at Kenya, we have the alternative investments funds regulation that's come up. When you look at Uganda, we have the partnership regulation that's also been. So, but it's also a lot of work behind the scenes to lobby for this. And that's why I think association bodies are also important, because that's the role that we actually play.
Hello. Thank you for the work that you do. It's very important work. And I think that the countries who are able to work on startup acts, I know that is the first step, right? I think the people that do all that bloody work actually are starting the conversations that we can build on. So can we please give a round of applause to my panelists, please? Okay, so we have time for one or two questions from the audience. So I don't know if we can get a mic to them. There's a lady at the back with her hands up. So maybe a lady and a guy. Okay, great. So, oh, great.
Hi, thanks for the excellent conversation. It was really informal. Really formal, sorry, I should say. So on one side, you speak about, for example, high impact investment, which, for example, is in the climate space. And I immediately translate that into, for example, high technology, which is looking at biotechnology. However, on one side where that's being promoted, what we're actually seeing is low ticket sizes that don't exactly translate into something that's meaningful for biotechnology firms. So what I would want to know is what exactly is happening in the VC world to translate that technology into something that's actually meaningful and can be actually something that's high value in the future. especially considering that when it comes to IP generation, in sub-Saharan Africa, only 1% of IP is actually generated out of the continent, and that's specifically correlated to the fact that we have extremely low ticket sizes in this space. So I would really like to know from a private equity side, specifically related to VC funding, what's happening with the ticket sizes and how does that translate into actually supporting biotechnology spaces? Thank you.
Thank you so much. We have one more question from someone behind. So we could just take both of them at the same time. No, that's the guy at the back. I think he asked a question.
Okay, thank you, the panelists. Okay, my name is Bayo. I'm the founder of AgroVesto. I'm actually playing in the Agritech space, and over the years, I've seen low funding in that space. Before fintech, became something that everybody knows about, bank has been solving the problem of finance to a large, some extent, before fintech now came and disrupted the space. Now, for me, over the years I've been playing in agri space, I've not seen a VC to actually invest in that space to solve the problem. We all know the problem that we have food insecurity in Nigeria. We know. But I don't know why it's now become difficult for VCs or even impact investors to actually invest in that space and ensure that the founders playing in that space can actually disrupt and cause that same disruption that happened for fintech, between fintech and bank today that we can see. How can we now disrupt that space today? And that's exactly the question I'm actually asking now, that who are those actually that want to invest in that space and enable us that are playing there to actually thrive in that space?
Thank you, Bayo. Can we take the last guy and then we're done with questions? Can we get a mic to him, please? Please, can you be very brief with your question?
Yeah, sure. Good afternoon. My name is Leo, founder of AI. So my question is related to logistics. So when we look at the last 10 years in Africa, what is happening with all the investment that were made in logistics? So from your perspective, what went wrong and what are the lessons learned? So we know what happened with Sandy, Lorry, Kobo, and the list on and on. So can you share a bit
your
your
question
view?
is not clear. What has been going on in logistics in 10 years? In what context?
No, I mean, the investment, I mean, when we look at what happened with Lori and Sandy, they are not really doing well. So what went wrong, basically, from your perspective, basically, in terms of risk?
So I'm thinking it's maybe issues about plenty of funding, no exit, or they're shutting down, or I don't know. I'm projecting. I hope I'm guessing your point. Is that the point? Fantastic, because I didn't hear a word, but I picked things. Tony, you want to take the one on the climate question? Who's taking the one on logistics? Why is logistics not working after all the money that we're giving them? You want to take that? All right, thank you. There's a third question. Bayo said something about agric. Yes, he's building in Agritech. Where's the money for agric? You want to take that? I think we had hinted that impact investments, but we can say it again, basically.
Okay, Toyin and I will both, I think, address the first question, but I'll also try and speak towards the Agritech one. I think on the biotechnology question, it's a wonderful question and a really huge challenge, actually, with regards to the IP drain almost in Africa. And part of that is, one, with regards to where's the funding coming from and what is the requirements with regards to those funders, with regards to where they want the IP domiciled. But it is also a result of our regulators oftentimes not being strong enough with regards to IP domiciliation and ensuring that IP stays in Africa, right? So I think it's a really big challenge. With regards to funding, part of the challenge oftentimes is that, VC funds obviously invest in different stages. So there's funds who will invest in idea stage, in MVP stage, in sort of R&D stage, and then there's funds who will only come post-revenue. There's funds who will only go growth stage. There's a whole sort of value chain of that, and I think it's really to identify who are the funds and sometimes not only VC, but also grant funders who will actually come in. And I understand that sometimes the ticket sizes can be small, but there is, in fact, oftentimes actually quite significant grant funding out there, especially for R&D, for biotechnology. I know you probably have walked the route and you're like, yeah, actually there's not. Hear you on that one. We're both eager to have a sidebar conversation with you afterwards. Very quickly on Agritech, I think there's actually been quite a number of successful raises by Agritech firms, Mr. Bio. So maybe you want to just do a little bit of research on, who were those financiers, but also who were the companies. What was the solution? Why did they get funding? What was interesting? Give a call to the founder, ask them their experience. Sometimes goes a long way to, sort of touch base in the ecosystem.
Thank you. I'll try to be quick and just build on what Asha said, which I completely agree with. On the first question about biotech, to the point that Asha was making around different stages, and also to the point that we made about risk return earlier, the reality is that you might need $20 million to deliver a product to your market, but it's not prudent to have access to that $20 million at once, or at least the funding landscape doesn't allow for that. And so you end up having to manage a first investment of like 200K. But the idea is to break down, agile thinking, break down the end goal such that there are a series of proof points you're going through, proving the product and its viability and its stability in something like biotech, in the ability of having that product or service approved by regulators before you even start talking about the market. And so the reason why, in my mind, one of the reasons why venture capital is designed the way it is because, and why it tends to like asset-light businesses is because what I call the cycle to feedback is relatively short. I invest $100,000 today, and really in 2 to 3 months' time, I should have an idea of if things are working or not. But if you have to go and build a manufacturing facility, I don't know what's happening until 9 to 12 months. And so those are some of the reasons why VC likes some things more than others. It's not just lazy investors. There's that, but it's not only that. And so I just wanted to add that to the biotech point. And also in terms of IP as well, the other thing, there are two other things. One is the trust in legal systems. It doesn't matter if you can register IP here if I don't trust the legal system here. And that point is against global benchmarks. So it's not just that there's a good legal system here, it has to have been tested and proven so that for me, as an investor who's raised money from a range of countries and different backgrounds, they have to be comfortable that if I'm investing in IP, then that IP can be protected. And so there needs to be a history of seeing it being protected in markets for people to be comfortable with that. And we can continue on the sidebar. I know you're itching to like, this is not my question. Answer, my friend. No, exactly. And to the agri question, look, if anybody here is building a business that you think is climate relevant, then if you're quick enough to grab me before I leave, try and grab me. If not, my colleague Yemi is here. And so he has work to do, but I'm outing him. Please, Yemi, stand up. Don't let that guy escape.
Grab that guy,
Grab him, take his shoe, whatever it is. But, we'd like to hear about what you're building. We may say no. We say no far more often than we say yes. But, a lot of times it's also a process of understanding the founder, the product, the space, and things like that. And then Ash's point is correct. Agritech is starved. Agriculture, especially when it's directly exposed to primary production, is starved of capital. In fact, everything in Africa is. But there are funding sources. And there are actually quite a few examples of folks who have raised money and done well in Nigeria, Ghana, East Africa, North Africa. So there are examples out there. You should do more research and see if you fit into someone's bucket.
Thank you so much. Babaka, can you wrap up for us in like a minute?
Okay. I'll just speak specifically to the point on logistics. I won't mention any companies, but the situations I've seen in the logistics space are some of the issues that we have in the ecosystem. Businesses that were solely focused on top-line revenue and not thinking about productivity, not thinking about cash flow. And I think that's one of the key issues that we had there, is that investors also were part of the issue, in that they were encouraging companies to grow revenue, or at least gross merchandise value, as we call it in that sector, instead of incentivizing them to do good business that makes sense. And those companies ended up being jacks of all trades. They would move everything everywhere. And when at the same time you look, just like if we take like the cargo logistics using
We can hear you
trucks.
well.
If we think about cargo logistics with the truck model, the Lagos-Kano corridor alone generates more revenue than all the logistics startups in Africa have generated. So these startups could have focused on doing simple things that make sense. And I think investors have a part of responsibility there, but in the end, startups are businesses. They need to make money. We're very, we like flashy things in the venture space, but in the end, these businesses need to make money by solving a problem.
All right, thank you so much. Please, can you give my panelists a round of applause, please? Thank you for being such amazing panelists. Thank you.